Hey everyone, how's it going? That was the closing bell. So it is 1 p.m. on Thursday, December 14th. We were expecting maybe a little bit of a choppy day, the downward movement given all the upward side that we've seen so far. And at the open, we were expecting downward movement and then perhaps continuing into the day and perhaps not. So let's take a look and see how that actually developed today. So over here on our SPY, we did get that downward movement that we expected, but it was very volatile on the way there. We came and touched this purple line, touched that purple line, broke through the purple line. So look how well we reacted to these lines that we drew this morning. We even paused a little bit here at this blue line, the previous resistance. We had some consolidation around there later in the day, and we traded way down and then way back up. So this looks like a bear trap. Right? Bear trap is extreme downward movement followed by a pause. And then this one was not the classic. This one didn't actually trap. It actually failed. And then it went even further and we got another bear trap, extreme downward pressure to an extreme level, and then a rapid movement back upwards to catch all these people who freaked out and started going short over here. So we definitely want to be careful of that. There is a heightened ability for these things to happen, for algorithms to cause these types of traps when we have, lowered volume. And today wasn't super low, but it was actually a little bit better than the average here. But that average has come down because we had so many below average days over the last month. So right now we just have to be very careful, especially at these extreme levels, for a lot of traps to happen, because there are people who are going to anticipate these going down. And when they see that downward rush, they get excited and go, oh, it's happening. And then they go short and then they get trapped when that happens. So we just want to be careful that we are not emotional, that we don't go too crazy and that we just allow the market to dictate what we're doing. So over here on the daily chart, if we look, we did get above that purple line, but then we just kind of petered out and we ended right on that purple line right there. So tomorrow is going to be very telling. Tomorrow is most likely going to be very volatile because of quadruple riching. So we'll see if we actually get any directional movement. That movement is up or down. That's going to be very important to see. If we keep going parabolically higher to the sea green line, or if we peter out over here and start to head downwards. Of course, we could always consolidate, but that is the lower probability situation in this case. I said that over here as well, and we got that low probability situation. But to have two of them in a row on such a strong movement, on a strong month, after such a strong year, I would be very surprised if we get consolidation once again. That would mean that this market is extremely, extremely strong, extremely exuberant, has complete faith that the Fed is going to lower rates and that nothing else is going to go wrong in the world. You've got the United States somewhat involved in the Ukraine war. At least economically, we are heavily, heavily involved. Tens and tens of billions of dollars poured into the Ukrainian war. And then we've got the Middle Eastern, or the Israeli-Palestinian conflict. And even though we're not necessarily backing them with weapons and economics, but at least politically, our official stance, the United States government, I'm not saying the people, but the executive branch is continuing to support Israel, despite the rest of the world not really supporting them. So right now, you've got the United States engaged on two fronts. You've got the Congress, the Senate and the Congress kind of up in turmoil, still not able to make decisions, ousting the GOP leader, now threatening to oust the second GOP leader. So you've got a lot of political turmoil in the United States. And if there happens to be a third item that comes along, that could spell a lot of trouble, because what we know from historically is that any nation that engages on a war on two fronts loses. And if we start engaging on a war on three fronts, even though we're not fully engaged, then that's going to spell doom and disaster for the United States and its policies. So all that has to happen is China decides to invade Taiwan, or some other thing comes onto the map, and the United States decides to dip their toes into that as well, somehow get involved, and then a lot of things start to fall apart. We're already kind of in an unstable situation. So this kind of exuberance and high movement upwards matched together with the political and economic environment that we have right now is all of that is a recipe for all it takes is that straw that breaks the camel's back, right? And we start pulling back hard. I'm not saying that we go into a bear market. I'm just saying that's all we need is this tiny little thing for us to start collapsing and pulling back, which is what this market needs anyways, in order to be able to really continue to move upwards. In the meantime, we trade the market that we have. We are still slightly leaning towards the long side, but I am more and more interested in hedging my portfolios to going and getting closer to neutral. So for now, that looks like anything that looks like an extreme. If I look at VIX, okay, so VIX started to recover from this red line I wrote over here as I identified as a stop loss. I believe that was for the example trade that we did on VIX. So this long that we did a little while ago as a hedge, then it's been down, but that's okay because we are expecting it. We don't expect to make money on our hedge. We only expect to make money on our hedge if things go wrong and go against what our viewpoint was. And our viewpoint was that, okay, we're in an uptrend, but we need to protect against a pullback. So that pullback hasn't happened. So of course we're going to lose money on this, but this is just a hedge. So we said that, okay, maybe we'll get rid of our hedge if that VIX dips below that red line, and we're sitting there right at it. We came and touched that red line, and then today we're starting to move upwards. So that's interesting because the SPY, I believe, is up. Yes, it's up 0.32%. So there is starting to be a little bit of divergence between the VIX and the S&P 500. So yes, we did end up higher. We did end up lower than the open, but higher than yesterday's close. So that's an up day. Volatility is increasing. So there's a lot more, not a lot more, but there is more uncertainty today than there was yesterday. So we're starting to get on a little bit of shaky ground. So in terms of a hedge, I still like VIX. Right, VIX could easily spike up. This level that we're at, or that low that we saw yesterday, is the lowest level we've seen since all the way back to 2020, January of 2020. So that's before, before COVID. So these are pre-COVID levels right here. Am I getting my dates wrong? No, I'm getting my dates. That's correct. This was COVID. This giant spike right here was COVID. That huge off the chart, off the scale spike, that's COVID. So we're at pre-COVID levels right here, which is kind of crazy, right? Because the world is not calm. It's not back to what it was before COVID. There's still a lot of lingering effects of COVID happening. So this as a bottom has very high potential. And we still do see that massive amount of institutional money that went into January calls in the VIX. So a re-upping or a refreshing of our VIX hedge is appropriate because this has lost some juice. It's lost half of its value. And so its protective power has been diminishing over this time period. So it makes sense to go into another VIX call if we want to preserve that hedging power of the position that we had. Another extreme that we see is, let's take a look. So the Dow Jones is ridiculously high, continued to move upwards today, up 0.43%. And you can see that we're just really departing from that +3 ATR. This is really, it really needs to go sideways, or really what it really needs to do is pull back, because we've been following this plus 3 ATR and then popped way above it, then came back and touched it and just went above it. We've been going at this for a really long time in the Dow Jones. So a lot more so than in the S&P 500. Yep, and a lot more so than even the QQQ. QQQ is just barely touching its plus 3 ATR. And then small caps. Small caps has now gone to an extreme as well, where they're gapped up above the plus 3 ATR. Now, the good thing is that we passed this pink line resistance right here. We did that yesterday. We gapped up and touched the second peak line resistance and then didn't quite make it over. We made it over, but we didn't stay over it. So we'll see. This is pretty extreme. This is gap up, sideways, parabolic, sideways, parabolic, and gap up. And then if it goes sideways, then this will be really, really strong, and it's definitely time to start looking at small cap stocks. But more likely it's going to pull back. And then once it pulls back, then it'll be time to look at small cap stocks. So the Dow Jones is a little bit more extreme than the IWM right now. So I would be very comfortable with puts in the Dow Jones as well as a hedge. What does that mean? That means for sure on a hedge, you want a very favorable reward to risk ratio. You don't need high probability because you're hedging. You're protecting against the lower probability event. So you don't care about the win rate. What you're caring about is that when it triggers, that hedge is really going to provide some protection to me. I don't want my hedge to make 10 or 20% if my whole portfolio is going to go down 20, 30, or 40%. I want my hedge to protect against that, because my hedge is also naturally a smaller position. So if my hedge makes 200% and my portfolio goes down 20%, I might still be at break even, because the amount of money inside of my hedge is a lot less than the amount of money inside of my entire portfolio. And that's the way I want it, because my expectation is that most likely my hedge is going to be wrong. I'm going to lose that money inside my hedge. So I want the money inside my hedge to be a small amount. I don't want it to be the same amount as my portfolio. And I just want it to provide me outsized protection, so that instead of my portfolio dropping 20 or 30%, it only goes down 10% or 5%. I don't need it to cover the entire amount of the loss, or actually to make my portfolio money while my other positions go down. So we got to remember what a hedge is. It's like a seatbelt, right? A seatbelt doesn't stop you from crashing. The seatbelt doesn't necessarily stop you from getting injured, but a seatbelt can protect you from getting killed. So that we're putting on our seatbelts. So we just want to make sure we appropriately size, and that what we're looking for is a really good reward to risk ratio. So let's take a look at what that might look like. So if I go to, actually maybe I'll do it over here. It'll probably be a little bit easier. So let's just say I want to hedge using diamonds. And I'm going to say, well, I'm not really sure when this pullback might happen, probably within the next month. And I don't want to buy more than 1 month of protection anyways, because then it gets really expensive. So I want to protect my portfolio for the next month. And so I'm going to choose this January 19th expiration. And I'm going to look for a put. And what I want is, if my portfolio goes down, let's just say the Dow Jones. Let's just say what am I concerned about? Maybe I'm concerned that it goes down to the purple line. That's actually not much of a pullback. Maybe I'm concerned it goes down to EMA 20. That's more of a pullback, but it's not a huge pullback. What if it goes down to the MA 50? Okay, so that MA 50 is at 345. And let's say it takes a few days or maybe a couple weeks. So maybe by that time, that MA 50 is at 350. So I want to know by sometime between now and January 19th. I don't know exactly when. So more conservative would be to put it later on. So actually on the day of my expiration. If we go to 345, or sorry, 350, theoretically, what are all these values going to be? And it's not calculating them for me, unfortunately. Oops, sorry, because I did something wrong there. Okay, so we go down 23. So what I want to know is what would all these theoretical prices be? So I can't go way out here because all of these go to zero. So I lose money. So then they're not providing me any protection whatsoever. So this one goes from 47 to 8 cents. I'm still losing money. That's not any protection whatsoever. This one goes from 60 or 70 cents to $4.85. Now I'm talking. Now I'm getting some protection. So the most I can lose here is $70, but I could, if we get the event that I'm afraid of, which is a pullback to the MA50, it becomes $480. So I make $410. So this thing of 5 or actually 6 to 7 X's, 7 X's, right? So it goes up 700%. The most I can lose is 100%. So that's a 7-to-1 reward risk ratio. This looks like a pretty good, oops, it was this one. Yeah, it was this one, 355. What about the 360 put? Well, this is at about $1, and that one will 10x to roughly $10, a little less. So we'll call it 9x. Okay, so 900%. So for $100, I could potentially make $900. So $100 loss, $900 gain. Okay, and then we could keep on doing this so at some point this ratio will drop off. So for example, this roughly call it $4 goes up to $22. That's 5.5. So 550% versus roughly 1,000%. So this provides me better protection at a cheaper price. And what happens is if I'm wrong and we don't pull back all the way to that MA50, then all I lose is this $100 versus however many contracts that I bought, depending on how much protection I want. So what I would look at is look at my portfolio. If the Dow Jones goes down to 355, how much will my portfolio lose theoretically? The way that I do that is I do beta weighting. I've showed you guys beta weighting before, so I'm not going to spend too much time right now doing beta weighting, but I can beta weight my portfolio. So I can beta weight it to the Dow Jones. And then it'll tell me if I had the right columns in place. Here we go, $33, $34. So for every dollar the Dow Jones goes up, this particular portfolio should go up $34, which means that every dollar the Dow Jones goes down, this should go down roughly $40. And it's not perfect because it's not a linear, it's actually a curve, but we use it as a rough estimate. So if we go down to 355 from 375, that's roughly 20. So if I go down 20 times, what was it, 40, 30 something, 33, 34, 20 times 34 would be roughly 700. Okay. So all I have to do then is I buy one of these. All I have to buy one. I spend $100. And then if we get that pullback that I'm protecting myself against, then this thing will cover my $700 loss and then some. It only cost me $100. And if I'm wrong, it only cost me $100. So this is what we mean by a hedge. We have to hedge. I don't care about the probability. Look how far in the money or out of the money this is. The probability for this to actually become in the money right now is rated at 15%. 15% probability that this is actually going to be worth something by the time of expiration. So I don't care about that. I don't care about the win rate because it's a hedge. I care about the protection it provides me, that reward to risk ratio, that 10-to-1 reward to risk ratio, which completely protects me against a loss if the event that I'm preparing for actually occurs. And if it doesn't occur, it only costs me $100, right? It's not going to put a tiny dent in my portfolio. This particular portfolio is $4,500. So is it going to kill my account if my $4,500 account loses $100? Absolutely not. But would $700 start to be kind of an uncomfortable loss? That would be roughly over 20%, 20 to 30% loss on account. Yeah, that would be kind of uncomfortable. It only cost me $100 to protect against that event. Okay, so this is what we mean by hedges. We're really focused on the reward to risk ratio and not at all on that win rate, because my expectation should be that, hey, we're in a uptrend. It should keep on going up. Of course, there could be a pullback, which is why we're buying the protection, but we really should expect it to continue going up. And that's why it's only a hedge and not going short a whole bunch of positions. So hopefully that helps clarify things in your minds. It helps you think about things more from a portfolio perspective. That's going to be it for today. I've been talking for a little while. So I will see you guys tomorrow in the pre-market session. All right. Thanks, guys. See you later.